If you own a data center REIT or you are looking at the sector for your dividend portfolio, you have probably seen the terrifying headline floating around the market. It usually goes something like this: tenant concentration risk. Specifically for the stock we are analyzing today, the headline number is enough to make any conservative Singaporean investor choke on their kopi. Imagine finding out that nearly 30% of a REIT's entire income comes from just one single tenant. If that tenant leaves, if that tenant goes bust, or if that tenant simply decides to negotiate hard, nearly a third of your revenue could vanish overnight. In a high interest rate environment where we are fighting for every basis point of yield, that looks like a disaster waiting to happen. You might look at that risk profile and think, this is way too dangerous for my hard-earned capital. But if you strip away the scary headlines and actually look at the operational mechanics, the real story is completely different. If you dig into the lease structures, the credit ratings, and the massive switching costs involved in this specific sector, that 30% number stops looking like a liability and starts looking like an anchor of stability. In fact, when you combine this with what I call the dry powder advantage, the real decline in risk is significant. We are looking at a REIT that has quietly beaten its IPO forecast, deleveraged its balance sheet while everyone else is drowning in debt, and is sitting on a war chest ready to buy distressed assets. This is a much more complex and frankly much more profitable story than it appears on the surface. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to make sure you have the best data available. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours dedicated to financial literacy in our region. We were also deeply honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls that the mainstream news misses. Today, we are going to do exactly that with a deep dive slide by slide through the 1H FY25-26 financial report of NTT DC REIT to see if it deserves a spot in your watch list. Let's begin with the methodical breakdown of the financials. First, we need to look at the core health of the business. I call this section boring but beautiful. If you are looking for the volatility of a tech stock like Nvidia or Tesla, you need to look elsewhere. This REIT delivered a boring set of numbers. But for us as dividend investors, boring is exactly what we want for the defensive portion of an SRS portfolio. Let's look at distributable income. This is the money that actually lands in your pocket as dividends. Distributable income hit you $17.4 million for the period. Now, on its own, that number is just a number, but context is key. This came in 3.3% higher than their adjusted IPO forecast. In a market where many REITs are issuing profit warnings or barely meeting expectations, beating your IPO forecast by over 3% is a strong signal of operational efficiency. This performance was driven by net property income, or NPI. First, let's define NPI. This is the core engine of any REIT. It is effectively the revenue from the properties minus the property operating expenses, things like maintenance, property taxes, and utilities. If NPI isn't growing, the REIT is dying. For NTT DC REIT, NPI edged out forecast by 1.7%. It wasn't a massive beat, but it was positive. Why? Because they managed their utility expenses better than expected, and the rental income flowed through efficiently. For us as Singapore investors, this is exactly what you want to see. A management team that underpromises and over-delivers, even if just by a small margin. It suggests they have a handle on their costs, which is critical in a high inflation environment. Now, let's move to the most important slide for anyone worried about interest rates, the balance sheet. Specifically, we need to talk about aggregate leverage, often called gearing here in Singapore. Gearing is essentially the ratio of the REIT's total debt to its total assets. The Monetary Authority of Singapore, or MAS, sets a hard limit of 50%, but generally, once a REIT crosses 40% or 45%, investors start to get very nervous because it limits the REIT's ability to borrow more money for growth and raises the risk of a rights issue, where they ask you for more cash. Here is the kicker for Singapore investors. tired of seeing REITs dilute shareholders to pay off debt. NTT DC REIT's aggregate leverage dropped to 32.5%. This is down from 35.0% at the time of their IPO. Let that sink in. In a market where many S-REITs are sweating near the 40% to 45% leverage limit, trying to sell assets just to keep their heads above water, NTT sits on a massive safety buffer. This 32.5% is incredibly low. It means they have what I call dry powder. To be precise, they have $121 million in debt headroom before they even hit the 40% leverage mark. From Iggy's perspective, this is the single biggest bullish factor for this REIT. This isn't just safety, it is ammunition. When other REITs are forced to sell properties at a discount because they are over-leveraged, NTT DC REIT has the balance sheet capacity to step in and buy those assets. Furthermore, looking at their debt maturity profile, they have no debt maturing until FY 28-29. This effectively insulates them from immediate refinancing risks. While other REITs are refinancing debt at 4% or 5% right now, NTT has locked in their costs for years. That visibility is worth a premium in today's uncertain market. Next, let's look at the portfolio performance, specifically the S in your SRS, stability. We need to analyze occupancy and rental reversion. Occupancy is simply the percentage of the building that is rented out. Portfolio occupancy for NTT rose to 95.1%, which is up swooping 8% from the IPO levels. This growth wasn't just luck, it was driven by strong renewals. But the more important metric here is rental reversion. First, let's define rental reversion. This measures the change in rent when an old lease expires and a new one is signed. A positive number means the landlord can charge more. A negative number means they have to drop the price to keep the tenant. NTT reported a positive rental reversion of 5.1%. This tells us something very important about the data center market. Demand is outstripping supply. Landlords have pricing power. Even with existing tenants, they can push rents up by 5% upon renewal. For a Singaporean investor battling inflation of 3% or 4%, a 5.1% organic growth in rental income is exactly the kind of inflation hedge you need in your portfolio. Now, I want to zoom in on a specific asset that is close to home. The report highlights their Singapore asset known as SG1. For those of us who like to drive past our investments, or at least know they are on our sovereign soil, the Singapore asset is performing exceptionally well. Occupancy at SG1 jumped significantly by 3.4 percentage points to reach 93.4%. This is a crucial development. It helps offset some softer performance they saw in their Vienna asset VIE1, which dipped slightly. This highlights the strength of the Singapore data center market, which remains a key connectivity hub for Southeast Asia. Knowing that a significant chunk of the portfolio is anchored in Singapore dollars, and Singapore law provides an extra layer of comfort for local investors. However, we cannot do a proper analysis without looking at the risks. We have to address the elephant in the room. While the metrics are strong, there is a severe concentration risk that you need to be aware of. The top 10 customers account for a staggering 73.2% of the monthly rent, but it gets more concentrated. The big one, a single tenant described in the report only as a Fortune 100 US automotive company, accounts for 29.9% of the total rent. Let's analyze this. If this was a retail mall and one fashion retailer paid 30% of the rent, I would tell you to sell immediately. Retailers go bust all the time, but this is a data center. We need to look at the WALE, or weighted average lease expiry. This tenant has a WALE of 8.0 years. That means they are locked in contractually for nearly a decade. Furthermore, they have an investment-grade credit rating of Baa3 or BBB. Here is Iggy's perspective on this risk. While 30% exposure to one tenant sounds scary on paper, in the data center world, sticky tenants are the norm. You have to understand the physics of IAT infrastructure. It is incredibly expensive and difficult for a hyperscaler or a major auto firm to move servers. We are talking about downtime, migration risks, latency calibration, and physical relocation of sensitive hardware. Once a tenant moves into a data center, they essentially become married to the facility. As long as that tenant is creditworthy, and a Fortune 100 company generally is, this is an acceptable risk for the yield we are getting. It's not a risk-free trade, but the stickiness mitigates the concentration. Now let's shift gears to the macro outlook. Why should we remain bullish on this sector overall? It comes down to the basic law of economics, supply and demand. The report gives us some fascinating insights into the US market, specifically Northern California and Northern Virginia, where NTT has major assets. The theme here is power is king. In Northern California, power delivery timelines from utility companies are now stretching into the early to mid 2030s. Think about that. If you want to build a new data center today, you might not get the power cable connected for another 7 to 10 years. In Northern Virginia, the data center capital of the world, power constraints are pushing lease rates up across the board. What this means for you as a shareholder is simple: scarcity value. If you own existing data centers with power already connected, which NTT does, you have immense pricing power. You hold the golden ticket. Tenants cannot simply go down the road and build their own facility because there is no power available. This creates a moat around the business that is incredibly difficult for competitors to breach. Closer to home, the report notes the Singapore squeeze. Singapore demand continues to outpace supply due to the lingering effects of the moratorium on new data centers and the strict carbon criteria the government has imposed. But here's the interesting part: the spillover effect. The report explicitly mentions demand spilling over to neighboring markets like Johor. This confirms the regional thematic we've been watching on this channel for months. Singapore remains the HQ, the brain, but the muscle, the raw storage growth, is radiating outward to Malaysia. However, because supply is so tight within Singapore itself, assets located here command some of the highest hyperscale pricing in the region. Owning SG1 puts NTT right in the sweet spot of this high value demand. So let's bring this all together in Iggy's assessment. What is the verdict? Let's start with what's working. The balance sheet is an absolute fortress. At 32.5% leverage, they are one of the safest REITs in terms of debt profile. They have no refinancing pressure for years. The operational metrics, occupancy and rental reversion, are trending up, and they are exposed to the secular tailwinds of AI and data growth, particularly in power-constrained markets like the US and supply-constrained markets like Singapore. Now, what's not working or the risks? The tenant concentration is high. There is no getting around that. If that one auto client faces a catastrophic idiosyncratic event, the dividend will be cut. Also, the portfolio is relatively small, only 6 assets. This means any single issue at any single building has a larger impact on the bottom line compared to a giant like Digital Realty, which owns hundreds of buildings. In terms of valuation, the yield is attractive relative to the risk, especially considering the low leverage. The market is currently pricing in some of that concentration risk, which gives us an opportunity. So here is the final recommendation. For existing unit holders, I rate this a solid hold. You are collecting a steady yield from a company with a pristine balance sheet. The yield is decent, and the dry powder suggests they could grow the dividend through acquisitions in the near future. Do not panic sell based on the concentration headlines. Sit tight and let the lease expiry profile work in your favor. For new buyers, I would say accumulate on dips. Think of this REIT as the infrastructure backbone of your portfolio. It won't double in price overnight like Nvidia. It is not a get-rich-quick scheme, but it provides the steady, tax-efficient cash flow needed to compound wealth in your SRS or cash accounts. Keep an eye on the price. If general market fear drags the REIT sector down, or if interest rate jitters cause a sell-off, use that as an opportunity to deploy your capital. Specifically, watch for news on acquisitions. With US $121 million in debt headroom, a new acquisition is likely coming. If they buy a tier 1 asset from their sponsor, the NTT Group, it could be a major catalyst that diversifies the tenant base and boosts the DPU. That is the moment where this stock could re-rate significantly. If you found this analysis valuable and want to go deeper into the numbers, consider becoming a free or paid subscriber to the Investing Iguana Substack. That is where I publish the full charts, the raw data, and the specific price targets that we don't always have time for on YouTube. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support literally keeps the lights on and allows us to stay independent. Thanks for watching. Keep your leverage low and your standards high, and I'll see you in the next analysis.